Welcome back. Well, a quick look at the markets. We are not seeing too much relief, but at least the Nifty Juniors now come back into flat terrain, and the mid caps and the small caps have kind of stopped. The erosion has stopped, but we are not really seeing too much by way of a recovery either. As you can see, that marginal stopping of losses has happened. Markets, you will have to say, are flat. So rather than quibble about it, let's turn to personal finance. Sumeet Vaid of Freedom Financial Planners joins us. Sumeet, welcome to the show. We often hear that equity is a long-term asset class generating above inflation returns over a longer period. You know, that's the received wisdom. In practice, however, a lot of investors actually earn lower returns than usually even the benchmark. So how should retail investors improve their odds? Is wisdom to stick to mutual funds and not get into individual shares at all? And in mutual funds, do you really improve your performance against indices indiscriminately, no matter which equity index you choose, which equity fund you choose?
Thanks for getting me on the show, Lata. You're raising a very pertinent question because again and again we are seeing the same thing repeating for a retail investor. And my experience over the last 15 years, I've seen there are two kinds of returns. One is investment return, the other is an investor return. So investment return is a typical return which, let's say, a mutual fund is generating over a 10-year period. And if you see, most of the investment returns of, let's say, index in India has been 18% for the last 10 years, and many of the mutual funds have given in excess of 20%. For example, through ICICI Dynamics, 26%. Some of the funds like Birla Sun Life Frontline is 24%. But when it comes to investor return, they don't experience it. The reason for that is most of the investors keep timing the market. They come in at the wrong time, they get out at the wrong time. And the basic reason behind that is emotional, instability. Most of retail investors are not able to figure out how can they, stay invested in market over the down periods and reap the benefit. So somewhere there is a huge need for two things to happen. One, we need to emphasize on goal-based investing. Most of the retail investors who are coming into the market are very clearly not coming to get the highest return. Their emphasis is to try and achieve some of their life goals. If you can help them articulate those life goals in terms of amount, in terms of time, in terms of returns, it becomes a very good handle to really go back to them and make them stay invested during the down periods. In other words, help them manage their emotional instability. So that's the first point. The second is the advisory quality, which is last mile connect with the customer or the retail investor, has to really improve, because most of the time we tend to see the advisors behave just like the way the customer is behaving.
That's a fair point, Sumeet, and it's important that you put up in your data the equity mutual funds investment over 10 years, because we have had innumerable viewers on our show telling us that they have stayed 5 years in several mutual funds and the return is next to nothing. I mean, flat, barely principal protected. Most of them obviously in the 2007-2008 period. So obviously it's important to look at a 10-year cycle. We'll take a break. We'll have lots of viewers lined up on these lines with questions for you.
Welcome back. Still hovering in that range, 6,056 on the Nifty. In the last few minutes, it's inched a tad bit higher. But again, we're talking about a 25-point range that the Nifty has maintained through the trading session. So still in that. Just keep your eye out on PFC. It comes out with its earnings today. And ahead of that, that stock has started moving higher. So PFC has a gain of about 3% as we speak. So there has been some movement in that counter in the last few minutes. But back to a personal finance segment. We've got Dolly Sood, who calls us from Mumbai with her question. Hi, Dolly.
Hi.
Could you tell us your question?
I want to invest 10,000 per month in mutual fund for long term, so that it can help, with increasing inflation, which will help me at the end of the 10-15 years to give me good return.
Okay. Sumeet, how would you break up her 10,000 per month, and could you recommend any kind of mutual funds for her to put it in?
Sure. My first recommendation will be to have a goal which is much more precise than investing in mutual fund and beating inflation, because most of the time the problem happens is we are not able to articulate the right goal, and because the right goal is not there, we are not able to stay invested in market for a long period of time and managing our emotions, resulting in suboptimal returns, hence blaming market, hence getting in at the wrong time, getting out in the wrong time. So first advice, get a goal right. In this case, since you don't have a goal, I'm articulating a goal for you. Let's say you are planning education for children, I don't know anything about it, so I'm just for an example sake taking that. And it's an education goal whereby the current cost of education is 10 lakh rupees and you have 10 years to plan for this. So 10,000 rupees if you really invest at the return assumption of 12%, which is being divided between equity, fixed income and gold at 70, 20 and 10, your return expectation is around about 12.5%. That itself at a 10,000 rupees month will become 19 lakh rupees over a period of that time. Now, now the point is the mutual fund which you should do is post asset allocation. So asset allocation recommended by us is 70% gets into diversified equity funds, 20% into fixed income fund, and 10% into gold. On the equity side, recommendation will be Birla Sun Life Frontline Equity, Pru ICICI Dynamic Plan, and HDFC Top 200. On the fixed income side, Birla Sun Life Dynamic Bond Fund, that'll be a great fund, and on the gold side, it'll be a Reliance Gold ETF or a fund of fund which they have. So this will be an asset allocation which I'll be recommending. But again, I'm reiterating, your goal cannot be beat the inflation. Your goal has to be much more closer to your life goals, which can help you stay invested to reap the optimal returns.
Fair enough, Sumeet. So that's where we should attack the problem. Try and fix your goal, and then you will not be tempted into getting in and out of mutual funds every now and then. Thanks a lot for joining us, Sumeet, and thanks, Dolly, as well, for your question. Remember to join us, viewers. Tomorrow, Harshvardhan Rungta will take us through whether it's time retail investors begin to look at investing a part of their assets in international markets.